Welcome back. In this video, we'll continue working through Chapter 11. We'll talk about some of the things to consider when deciding whether or not to include cash flows on a cash flow timeline for a project that we're going to evaluate. There's a mini exercise associated with this video that I think hopefully won't be too much trouble. Let's pick up where we left off. We left off talking about incremental cash flows, right? Cash flows that happen if a project is pursued, and then these cash flows do not happen otherwise. So actually, if you take a look under other resources, there's a little spreadsheet that works out the net present value of that energy efficient pizza oven example from the previous video. Good stuff. Well, let's talk about these other guiding principles. And again, we don't have to memorize them. It's helpful if you can understand the intuition as we talk through each of them and recognizing an example of each. So let's go through them. So sunk costs first. Sunk costs is money that we've already spent that can't be undone, right? Money that we've spent in the past. Maybe things like market research. Like if we commissioned a market research study 2 years ago to examine whether there's demand for some product we're launching. Regardless of whether or not we pursue the project at this point in time, the money's already spent, right? And that can't be undone. So it's not an incremental cash flow. If you understand that, that's great. And so we ignore sunk costs. Can't be undone. Right. Some other guiding principles, opportunity costs. These are hard to measure, but in econ terms, what's the value of the next best thing that we give up by pursuing a given course of action? Those are incremental, and estimating the value of things that we actually do is hard enough. But then opportunity cost is like, well, what's the value of the thing that we're not doing? Well, that's even harder to quantify, I feel like. But a couple examples. So I guess one big one that comes up in real estate development is, well, suppose we've got a plot of land and we could build an office building there, or residential or commercial, or self-storage, industrial, right? A lot of different mutually exclusive projects. One opportunity cost would be, well, what if we just sold the empty land as it is, right? That's one example of an opportunity cost. And it's something we should compare a project to, right? Include opportunity costs when figuring out what cash flows to put on a cash flow timeline. So exclude sunk costs, include opportunity costs because they are incremental, right? If we build something on the land, we give up the opportunity to sell the land, so that cash flow would not, the loss of the opportunity to sell the land happens if we do the project. Side effects are more straightforward, include incremental side effects, right? So positive side effects and negative side effects. Negative side effects would be an example, the latest iteration of smartphones is a good example, right? When Apple comes out with their latest generation of their iPhone, whatever that is right now, right? Sales of the previous generation decline. That's a negative side effect, right? If I come out with a 6-bladed razor, sales of my 5-bladed razors are going to decline if I'm a razor manufacturer, right? So those are negative side effect examples. And then there's also positive side effects that we should also take into account, right? Incremental positive side effects. So an example would be, back to the shaving example, if, Gillette, when they launched the 6-bladed razor with the fancy 6-bladed razor packaging, sales of their complementary product, right? The co-branded fancy shaving gel, there's positive product synergies there, right? When Apple comes out with the latest iPhone that doesn't have the headphone jack anymore, sales of the Lightning to headphone jack adapter increase, and also sales of AirPods increase as well. So complementary products, you can see positive synergies, right? Substitutes, you see negative synergies. And so we want to include both positive and negative incremental side effects. Hopefully that's clear. Our textbook makes a big deal about neglecting working capital. So working capital, remember, it's short-term assets and liabilities. And really, I guess something to emphasize is include incremental changes in working capital. So, a typical project, when it gets up and running, it requires some working capital to get started. And then working capital is sort of level for the life of the project. And as the working capital, as the project gets to the end of its life, it kind of declines towards the end. So as long as we consider those incremental changes in working capital, I think you'll be all right. So exclude sunk costs, include opportunity costs, include incremental indirect effects, right? Positive and negative side effects, and also include incremental changes in working capital. And then things like wrap-up costs, right? Negative, if there's environmental impact, for example, negative cash flows associated with cleaning up after yourself. We should include those if they're incremental, or if we can sell some assets like manufacturing equipment when a project's life is over, we can sell some assets for money. We should include those if they're incremental. And then allocated overhead costs, things like utilities, right? A firm's electric bill or water bill. Just think about incremental changes in those. So sometimes with fixed costs like rent, it can be tempting to assign like some portion of a firm's rent to a new project that's happening in a building. But adding that project, if it doesn't increase rent, then there's no incremental rent cash flow. So if you can think about cash flows being incremental, I think you'll be in good shape. This one is a little bit different, but the financing cash flows are already included in the discount rate, right? Like coupon payments, dividend payments, things from bonds and stocks. Those are built into the discount rate of firm's cost of capital, so we don't include those. But I wouldn't try to trick you by asking you to include financing cash flows on a cash flow timeline. And then last thing, just to emphasize, is a cash flow incremental? If a cash flow is incremental, we want it on the cash flow timeline. If it's not, don't include it. And if you're not sure, just feel free to get in touch to ask about it. So we've just really scratched the surface about how to estimate a project's cash flows. There's a lot of different ways, other ways you could take it. If you're interested in these, maybe think about talking to me about being a finance minor or major. Be happy to help with that. And in the next video, we'll actually have a little summary of a mini case from the textbook that will help you with some ideas about how to practice computing operating cash flows and some other things. So the mini exercise for this video is just to go out and find some kind of news article that includes something related to some of these guiding principles that we spoke about, whether it's getting back to the list, right? Find an article that talks about a sunk cost or an opportunity cost or a positive and a negative side effect or anything like this. Find a Wall Street Journal article that discusses something pertinent to what we've spoken about here. So thanks for sticking with me through this video. We've got one more on chapter 11, a short one, and then we'll be moving on. Thank you.